Good morning, everyone in India, Um and good afternoon, good evening to all others in different parts of the world. Yeah, so today I've come with a very interesting topic uh, when and how the markets are going to correct and why markets would correct. Um, Now, this is a very interesting topic. So, before I start, just by way of disclaimer, that in this webinar, I'm not promoting any investments uh, to anyone in North America and also not promoting any specific investments to anyone. This is just educational and knowledge based webinar uh, on the perceptions of how markets are going to behave in the coming few months and years, correct? And how we analyze it. So this is a uh, no specific advice I'm giving here, and this is for general knowledge. Okay, so let's. And today I'm coming with a lot of examples and change a little bit format of the webinar. I would like everyone to give us their feedback in the comment sections here and ask questions, and also please subscribe to our YouTube channel. I'm saying please subscribe because the more subscriptions we have, the more investments we can do in this knowledge-based initiative from Simplicity, and you'll get automatic updates because we are going to come with a lot of short and long videos uh, in the future. Okay, so let's start. Let's begin. So, how, when, and why stocks correct? Yeah, in life, everything. Uh, Markets don't go up every day, every month, every year, but over a longer period of time, markets always go up. So it's like this, correct? We don't feel happy every day, every time, every year. Happiness is also is like a stock market, correct? Some days we are feeling good, some days we are feeling bad, but overall a period of over a longer time frame, we always strive to be happy and we look for happiness, correct? So the same with the stock market is, correct? So please understand that stock markets don't go up every day. It can't go up every day, and if it goes up every day, it's very risky, very dangerous. And stock markets are like oceans, correct? They fluctuate within a range, and but they never go completely dry, and there's always water, correct? So this is the way the stock markets function. So now, how do you position yourself and how do you use stock markets to create wealth? So I'm going to talk about that. Uh, so now let's understand how many different types of corrections are there. So their corrections can be of four different types. When we talk of corrections, there can be a global correction. So correction means every stock market in the world corrects, correct? So there is a global, like 9/11 happened in 2001, then COVID happened in March of 2020, then Lehman Brothers crisis happened in 2008, where every market in the world, every market, no exceptions, corrected, correct? So that's a global, the correction is triggered by a global event, and all the markets correct worldwide, correct? That's one kind of correction. The second correction happens is country specific. So let's say the world market is stable or going up, but India corrects or China corrects. So let's take the latest example. In last 6 months, China corrected by 40%, but India, US, all other markets went up by 40%. So that's a country specific correction. That correction happened in China because the Chinese president made some changes to the regulatory environment there. Now, same thing can happen to India. Same thing happened to US. There can be a country specific correction, and that correction doesn't spread across the globe. It remains to that country. Now, then there can be a sector specific correction. So overall markets don't correct, but sectors correct. Certain sectors go down, certain sectors go up. And so that's the sector. So this happens every month, correct? The rotation, we call it market rotation. Market rotates. One sector goes up, other sector goes down. So that is called market. And there can be a stock specific correction. So within a sector, all stocks don't go down. Only one stock, few stock goes down because some specific event has happened in the company. Something specific event happened to the company, like uh, you take Anil Ambani group of companies, or you take Dewan Housing, correct? Certain specific things happen in that those companies and those stocks corrected, but other stocks didn't correct. So So the corrections can be of four types. So you need to understand when you're building a portfolio, you're investing, when you're talking about correction, what do you mean by correction? And now the correction also differs from degree, correct? So that I'm going to come a later part. But so when we are talking about global corrections happen once in 10 years. It doesn't happen every year. So we have first global correction in recent times happened in 2001, then 2008, then 2020. So I don't anticipate a global correction coming for next few years, correct? So global correction. Now, India-specific correction happens once a couple of years, 3, 4 years, correct? Sector-specific happens, the cycle goes up and down, correct? So this also happens over years. It doesn't happen overnight. And stock-specific can happen depending on what happen in that company. So everyone is we need to understand that. Now let's go to the next. So what is market correction? So again, there are two kinds of market corrections. So we say when overall index corrects up to 10%, it's a short term correction. Now, what that short term, so that doesn't mean the economy has gone from growth to depression or there is a turnaround. A short term correction happens because people buy stocks in futures, options, they take loans and leverage the holding. So when the leverage becomes very high, correct, that time a 1 or 2% fluctuation triggers a sell off margin call comes, and that triggers a higher correction. So because of that those kind of corrections happen up to within 10%. So this is a continuous process. That's a very healthy process of correction. The markets do correct at least 3, 4 times within a year, every year or every quarter. It corrects once or twice, up to 5 to 7%, and that's a very healthy correction. So that doesn't mean the direction of the market has changed. Now a meltdown, when we say a growth economy goes into recession, that time the corrections happen by 20%. When overall index corrects by 20%, you see that. Now, again, I'm not talking about 20% correction in a stock. I'm talking about 20% correction in an index. When index correct by 20%, the growth direction of the market changes. But markets go up or by 20% or go down by 20%, they say the direction of the market has changed. So that's called. So I'm making these concepts very clear because people are expecting corrections. I want to share that what kind of corrections you're expecting. Are you expecting a short-term correction of less than 10%, which is a very healthy sign and which should happen? Or you are expecting a meltdown more than 20%? I don't think meltdown is going to happen in at least the foreseeable future. And I'm going to share that logic with you. Why that? So you need to understand that, correct? So this kind of corrections are there. Now let's go to the impact of corrections. Now the impact of corrections gets magnified. So if global index corrects by 5% or Sensex corrects, Sensex may correct by 8%, small cap may correct by 12%, individual stocks can correct up to 20%, and retail investors correction. So when you are only dealing in stocks and you're not investing in mutual funds, your portfolio may be down. So market corrects by 5%, but you may see minus 12 or minus 15% in your equity holdings because some stocks correct much higher than this. So I'm going to show you by the example. So you need to understand index corrects the least. Index corrects the least, but stocks correct the most. So you may see some stocks correcting by 50, 80%, but the index is corrected by only 5 or 7%. And that's where retail investors get skilled if they don't understand how market functions and what how to build a portfolio. So this is what you have to understand, that large caps correct much small less percentage. They go down also less, go up also less, dignified. So in your portfolio 60 to 70% should be always large cap. Mid cap and small cap correct more than the index, and they go up also more than the index. And that's where most of the retail investors get hurt. So you need to understand when you're doing a portfolio construction, how do you mean by now when a markets global markets correct by 5%, it's a very healthy correction. It's a normal correction. You should in fact we always want markets to correct. We don't want markets to go every day up because that's a very unhealthy sign. So this is the way you have to understand the magnitude of correction. Now let me explain you this by actual numbers, correct? So I'm comparing here Tata Motors, Tata Steel, Infosys, Sensex, and Dow Jones. So you see the period here. I've taken the data from January 2018 to March 2020. So if you take January 18 uh, to March 2020, if somebody had invested 100 rupees in all these five stocks, Tata Motors, Tata Steel, Infosys, Sensex, and Dow Jones, so you see Tata Motors gave minus 84% return. So that 1,000 rupees, 100 rupees became only 16 rupees. See the kind of loss. Tata Steel, 60% down. You get killed in that. Infosys, a Nifty minus 20% down. Sensex minus 16% down. Correct. Dow Jones minus 15% down. Only Infosys gave a positive return 25. So this is called a correction, correct? This is now you see Nifty corrected by 20%, Sensex corrected by 16%. So this was a general broad-based market correction, correct? Recession went because of the COVID and 2018 to 2020, and you saw how Tata Motors corrected, correct? Now let's go to the next phase, correct? So what happened after 1st April? Uh, Now 1st April 2020 till today. See, Tata Motors has given 561% return. Tata Steel has given 381. Infosys 179. Nifty 100. Sensex 98. And Dow Jones 52. So the least volatile in this is Dow Jones. And then comes Sensex and Nifty. And Infosys has been consistently giving positive returns. Correct? Now, before COVID and after COVID. But you see Tata Steel and Tata Motors. So if somebody had invested in Tata Motors before COVID, he would have got panicked and killed in the market. And somebody who invested in Tata Motors post COVID, he made a killing, correct? So here you have to understand the stocks, they are much more volatile than the sectors and the indexes. So this is the magnitude what happens, correct? The effect of happens. Now, if I take the entire range from 2018 to 2021 till today, Infosys has given the highest return, 260% return. Now, if you see Tata Motors, if somebody invested in 2018, didn't panic, didn't sell in the panic, and kept the shares till today, he has got just 11% return. Nothing great, correct? 11% return, and that is 11% absolute return, correct? It's not per year return. So 11% return over a period of 4 years is 2.5% return, less than savings banks interest rate, correct? Hardly anything. In If you say Dow Jones has given 43, that means 10% return per year. Nifty and Sensex has given 80% return, correct? Tata Steel has given 104, and Infosys. So you can see how you construct your portfolio is very important. Now, if you go by news driven, haphazard, random investing, buying, you do that, you will get killed in this market. You will never understand what's happening to your portfolio. You'll never understand. So there has to be a strategy. So I'm going further now. So, uh, so what happens is that's why markets when they correct, all these weak investors or weak players, they get out of the market. Correct? They'll incur losses and so portfolio construction is key to manage the downside and take advantage of the market volatility. So how you construct your portfolio is a very key thing. So it's like portfolio construction is like, you're constructing a building. When you're constructing a building, you have to keep in mind there may be heavy rains, there may be floods, there may be earthquake, there may be um, thunderstorm, and your building should be able to withstand all those kind of stuff, correct? So portfolio construction is same way like what an engineer does when he constructs a high rise building. Yeah, so you have to keep all those factors in your mind. Now, the portfolio construction cycle, what happens is, correct? So when you when we construct a portfolio, before I go about the future, I want to talk about why constructing a portfolio to manage market volatility and correction is very important. Correct? So portfolio construction depends on two things: research and client risk profiling. And when we do that, we understand macro analysis, micro analysis, sector analysis, the client behavior analysis, client's cash flow, and accordingly we construct a portfolio for every client. It's not that what comes on CNBC, oh, you buy this stock and sell this stock, or read Economic Times. upgrade and downgrade. You don't do that. We never do that, correct? It's a portfolio strategy. Building a strategy is a long-term strategy. No one should invest in stock market if the money is required in less than 2 years. Equity investment should be only done for long term and build a portfolio, and it requires to understand how short term, medium term, and long term corrections and growth cycles are going to affect it. So this is what we do, correct? Now let's go to the next slide. So let's look at the BSE Sensex. But long term, everything goes up. So if you look at from 1980 today, see the Sensex has given 47,000% return, correct? So in the long, so if you are investing for 10 years and 15 years, you should not be worried about any corrections. But you should be investing in a very good sectors and very good broad base, correct? Not one or two stocks. So if you do that, you'll do very well, correct? Uh, Now Nasdaq, Dow Jones, and everything has gone up. That's I'm showing you the percentage. But Sensex has given one of the highest returns from 1980 till today. Now, but if you look at the same thing from 2014 till today, Nasdaq has given highest returns. So again, the time frame, understanding the time frame is very important. 2014 till today, Nasdaq has given the highest return, and Sensex has given only 137% return. Mm, uh, Dow Jones has given 120% return, and Nifty has given 142% return, correct? So everything depends on not Nifty, S&P 500, correct? Nasdaq is 300% return. Now, if you look at January to till today, correct? For January till today, again Nasdaq has outperformed. Sensex is the second best performing. S&P 500 is third, and Dow Jones is the fourth, correct? So if, again, different. So different sectors, different stock markets react in a different way, but generally they go all in same directions, correct? But the magnitude is different. But stock specific, the magnitude is even higher. So now markets have done very well in last 1 year after COVID. It has given 100% return. Um, Sensex and Nifty. So where do we go from here? Today Sensex is around 60,000, and where do we go from here? What would trigger the next market correction? So that's the question everyone is asking. So let's analyze some of the scenarios now. What we expect, correct? So let's take one scenario: probable reasons for market corrections. There are four reasons that market may correct. Oil prices go to $130 a barrel, which is $80 today. There's a very high inflation, as we are knowing that inflation is going up everywhere, India, America, everywhere. Food prices are going up. Supply chain, we hear in the news that there's a supply chain disruption, and there's a geopolitics, correct? China, America relationship, India, China relationship, all. So these are the four major reasons why market may correct, correct? Which um, I'm talking about the index correcting, the global correction coming. Now, there may be a stock, I'm not talking about stock specific correction. Stock specific correction may happen irrespective of this happen because what the managements do, correct? So, this is about a global corrections. Now, let's say if oil prices go to $130 a barrel, what will happen? The probability of oil prices going to $130 a barrel is almost 50% as of today. Today, oil is $80. And if it goes to 150, imagine the petrol, which is 110 rupees a liter, can go to 170, 180. Or government might have to reduce the taxes. In that case, the government balance sheet becomes bad. But petrol will be at least, if this becomes 130 levels, oil a barrel, petrol will be 140, 150 rupees a liter. Now, that impacts directly every person in India, correct? So what happens? There will be a political turbulence, uh, little bit. There will people be blaming the government for that. There will be high inflation. The impact of petrol prices going up has the highest impact on the middle class. The rich class doesn't get impacted much because how much they spend on petrol compared to their income, insignificant. But middle class spends a lot of money on transportation, so their expense on transportation, food, vegetables is much higher in their income compared to the rich class, correct? So rich class, the impact of petrol prices going up is not much. It's the middle class and the poor class which gets the burn. Energy stocks will go up. Stocks like Reliance and would go up, refineries go up, and there will be a rebalancing of sector funds. Overall, all markets won't go down, but there will be certain sectors which will do well, certain sectors which won't do well, correct? So if petrol prices go up, then interest rates are going to go up. So bank stocks will do well. Bank doesn't consume petrol, correct? So there are certain sectors which will do well, certain sectors, transportation sectors, like uh, car, automobile, those purchasing will be less, correct? People will buy less car. So those stocks may suffer. So it will be very specific, but overall market, if it's in the economy or growth path, it may not impact much. But certain sectors would be negative, certain sectors would be positive. Now, this is one scenario, correct? Let's go to the second scenario. High inflation, probability of high inflation happening, which is 75%. So, which is most likely to happen. Now, so what happens is inflation goes up, interest rate goes up. So, if interest rate goes up, rupee will depreciate. Cost of setting up new factories or businesses go up. So now today, if somebody wants to build a new cement plant or new steel plant, he'll have to take interest in loan at a higher rate, and his cost of building that cement factory or steel factory will be 50 or 75% higher than the established players. And now established players, they have already written off those factories, depreciation and everything. They don't have any loans, or their loans at old rates, and they have po- positive cash flow, so they have a competitive advantage on the pricing. So the stocks of those companies, see, old economy stocks, they will go up because there'll be uh, barriers to the entry, correct? And banking stocks will go up because banking stock inflation goes up, banks spreads will increase. As interest rates go up, bank spreads will go up, correct? So banking, financial services stocks will go up. The stocks like again automobile, some other stocks, discretionary demand, correct? Where like travel, leisure, airline stocks, they will come down. Yeah. So this is how you have to understand impact of high inflation. What would happen? Now let's take another scenario. Correct? Supply chain disruption. So if supply chain disruption happens, this is also actually happening today. Correct? Today, if you want a container ship coming from China to uh, it, US, it's impossible to get it. So Walmart, Costco, they have their own containers nowadays, own container ships. It takes months and months to get stocks. So the ports are blocked, correct? And the same scenario is worldwide today. So there is more demand and there is less supply. Pricing power of local companies goes up. So the companies which are locally manufacturing products, their pricing power goes up. Good for stock markets. So this is good for local companies. Their profitability goes up. Stock market establishes business will do well. That doesn't mean supply chain disruption means markets are going to crash. Mm, Certain sectors and stocks will do very well. So this is also 75% probability, which is going to happen. So what I'm trying to tell you here is that supply chain disruption, high inflation, high oil prices is not going to create a havoc for the current market rally. Certain sectors will rotate, certain sectors will change, and that's might happen. But overall, the market will still going in the upward direction. Uh, and we'll see now. What about political instability? Now, war between small economies. Uh, the war between China and US or major economies happening is probably zero. Hmm. They make noise, they may talk, but they will never go to war because of the nuclear deterrence they have, correct? So even India and China going to full-fledged war, the deterrence is very low, correct? I mean, it's very probability is very low. But small countries, correct, where they don't have nuclear, and you may see a war in Middle East, you may see war here and there, but that won't affect the global economies. The war between large economies is not likely to happen. Now, political turmoil in certain economies may happen because of oil prices going up, COVID impact, and that. But in that chances of happening in India are very low. So that's not going to cause a major correction worldwide. Hmm. And political turmoil happening in uh, large economies like US, correct? So in US, the election is there after 3 years now. We had just one election last year, so there's still 3 years away from the election. But um, we don't see a political turmoil happening in US, but you never know, correct? And India also, the election is after 3 years. Uh, Today, Modi looks very strong, very, very strong, correct? And when it comes to the national elections, uh, but as of today, we don't see that the probability of happening is less than 25%, correct? But we always have to say there is some probability happening. People may fall sick, leaders may fall sick, leaders may die in accidents. Those kind of events can happen. So you have to structure your portfolio accordingly. So overall, I don't see the markets going down. But the Indian growth story is going to continue to, for next 5 years. The probability of that happening is 90%. So corporate sector, what is happening in India? Corporate sector is getting more market share. Uh, Capex spending is happening by private sector. More and more new factories, more and more new infrastructure projects is coming from private sector this time. Large FDI is coming to India, and India's global realignment. All these are positive things. So what I'm trying to say is we may have short-term 5 to 10% corrections because of technical reasons, not because there is a recession in the economy. I don't see a recession coming to Indian economy. Indian economy is on a growth path for next 4 to 5 years. So overall direction market is going to go up, but we might see 5 to 7% technical corrections. So when you get a 5 to 10% technical correction, uh, but certain sectors may get 10 or 15% correction. Certain stocks may get 30% correction, as I showed you in the previous chart. So use that advantage to build your portfolio. Have a strategy. Have a strategy. I don't see market, but markets are not going to go up every day, correct? Markets are not going to rally 100% like it rallied in last 1 year. I don't expect market to go up 100% from 60,000 to 1,20,000. That probability is less than 10%. Uh, but the market going from 60,000 to 80,000, the probability is very high. Market going from 60,000 to 50,000, the probability is very low, very low. So the downside is if market goes from 60,000 to 55,000, yes, that's possible. Use that opportunity to invest, but that would be a healthy correction. But should you wait for that? I don't know. Market may go to first 65,000 and then come to 60,000 at the current level. Everything is case to case basis. So your portfolio strategy building has to continue, correct? So don't try to time the market and build the portfolio systematically. Corrections are opportunity to keep building your portfolio then rather than exiting the market. Anyone who exited from the stock market in last 30 years, no matter what level, he has lost money, correct? So whether you sold the stocks in 2008 correction, whether you sold the stocks in January 2020 before COVID, or you sold the stocks last year at 40,000, 50,000, at any level you sold, you, and you are reinvesting today, so you have lost opportunities, correct? So only people who keep the money and who are in the market always make money, correct? So you need to be in the market, you need to be in the quality stocks, you need to be in the portfolios and build your portfolio. Now if you require money for next 1 year or 2 years, there's some event in your family, some event in your life, and you want that money, yes, then you book profits, take the money out systematically. Don't take the money out at one go, do in lots, small lots, correct? And do that. But if you don't require the money for next 2 or 3 years, build your portfolio, because the inflation is going to be there. Your bank deposits, the value of your currency is going to go down. So this is a strategy which I see for. With this, I end my today's presentation. I'm open for questions. Feel free to ask me questions. Correct? Yeah. And I want, if you like this today's event, please share your comments and subscribe to this channel. Correct? Subscribe to this channel. Okay. So first question I have: hadn't the bad news of COVID trickled by March 20th? Couldn't it have been better to compare uh, December 19? Uh, yes. See what happened. What did COVID did? Correct. What COVID did? Uh, the COVID, there are a lot of leverages, people who leverage their investments and come into the market. That got cleaned off. So when always this kind of major global events shakes up the things and creates a very solid base. So that's why we use that base as a this thing. But even if you compare to December 19, still the markets are way up, correct? And December 19. Um, Yeah, so I remember uh, Sensex was at 40,000, 40, yeah, it was around 40, 41,000. And today it is at 60,000. So even from December 19, we have got 50% return, correct? Yeah. So, how the next question again is the same: how will inflation impact the markets and interest rates? So, inflation, a reasonable inflation is a good for market, correct? What inflation means, there is more demand for products and there is less supply. That's why prices are going up. Now, it's not a runaway inflation like we see 100% inflation in countries like Iraq or Afghanistan. I'm not talking about that inflation. I'm hyperinflation. I'm talking about reasonable inflation, which is 5 to 7%. Inflation is a good inflation. That means demand is more, supply is less. So the stock market will do well. Stock market will do well as interest rates go up. If interest rate goes up, some of the disruptive stocks like Zomato, uh, Zoom, and all these technology stock which are giving high discounting, Twitter, they may not do well, but old economy stocks, cement stocks, steel stocks, banking stocks, they will do very well. So if interest rates go up, so again there will be a rotation in the sectors. Mm, yeah, and there is another question which I got, that Zomato is making losses, and why it's still yeah, so there are companies, correct? So let me put it this way. We as parents, when we have kids, um, for f- we spend so much money on the kids, correct? For first 24 years, the kids are loss making. We have to spend money on them. After 25 years, they start earning money. Same thing happens in the businesses. When you set up new businesses, first 4 5 years, um, they incur losses. So even when we started Simplicity, it took us 8 years to become a profitable company. 8 to 9 years, correct? So for 8 9 years, we were pumping in money in the business and building a base, correct? So now these days, this new disruptive companies, they want to be market leaders and they incur losses for 10 15 years. So take for example Amazon. Amazon was burning cash, but it is acquiring new and new businesses, and see where today Amazon is, correct? So it not necessarily mean. So you take an example, correct? You take our examples in real life in our home. Uh, on our kids, we spend money for 24 years to make them chartered accountants, doctors, MBAs, or engineers. So we say he's a loss making kid? No. We are creating a future. We are creating a so same way in economy, these new companies are the kids, correct? On which the promoters who believe that in long term this is going to be a profitable business, and they acquire. So that's why they get very good valuation and pricing. So the perception has changed in the stock market. Yeah, and let me see if any more questions are there. Oh yeah, quite a few. Um, how far do you think the Sensex will reach in next 2 years? It's okay. uh, Very difficult to predict, but my guess is it can go up to 75,000, 80,000, and it won't be a one-way journey, but it'll go up and come down, go up and come down. So it'll go up by 5,000 points, correct, by 2,000 points, and that's the healthy way of doing it, correct. So your just the way of our happiness graph doesn't go 365 days up, correct. We are day 2 days happy, one day okay, normal, then one day something bad happens, and again we try to be. So same way, this markets will going to go up. Overall direction is going to be up. It can be anywhere between 70,000, 80,000. It depends, correct? But overall, the direction is up, correct? That mm, uh, yeah. So I've shared my view. Next question is on Zomato. Yeah, it's a if you invest 2 3% of your portfolio in those kind of stocks, it's okay. But you should not invest more than 5% because we are predicting on the future of those companies, their ability to sustain those losses and still eventually become profitable. So uh, these are disruptive companies, correct? They become monopolistic companies. They become so big that no other players don't can't come in eat their market. Like Uber. Take for example Uber. Uber is also loss making. Uh, uh, all these technology companies initially they were lost making. Google, see, Google gave everything free. Email account, Google Maps, everything is free, correct? So all these big companies they sell you everything free, and they build such a large scale, and then that scale they get a lot of data and information, and they sell that data and information, and that's how they make money on advertising. So it's a scale. It's about how big the scale they achieve. Based on that, they will get the valuation. The next question is, when we all talk about debt increasing for all government around the world, will the market benefit or have an adverse impact in the long term? Okay, so worldwide, historically, last 300 years, um, the government is the biggest borrower anywhere in the world, correct? Now, when we talk about, that question is, India's debt is not that bad. Uh, US is a very large economy and it can afford to take more debt, correct? So it's like this. Um, if I am earning 20 lakhs salary a year and I'm earning 2 lakhs salary a year, who can get better loans? The person who gets 20 lakh salary can get more loans from institution. So US is the largest economy in the world, and it is a $24 trillion economy. So it's a $24 trillion economy. India is a $3 trillion economy. Um, Pakistan is $500 billion economy. So imagine how much loans $500 billion economy can get, and how much loan a $24 trillion. So of course America can get more loans because the cash flow, the income is very high. So that doesn't mean that America is a bankrupt economy. I don't agree with that. Same way, I don't agree that India is a bankrupt. So we many times we say bank deposits are safe because it's a government of India undertaking, correct? So PF is safe because it's government of guarantees that. So we use that same logic both sides, correct? Oh, government is borrowing so much, so market will not do well. No. Yes, government is spending money, and if it spends money within reasonable 4 to 5% of its GDP every year, the deficit we call fiscal deficit, it's okay. It's not bad. But if it spends 15-20% of its um, fiscal deficit, then it's bad. So this government, the Indian government, has done very well to manage its debt level, and the India's balance sheet has improved. India's balance sheet has improved over in last 5 years, and US, okay, it's a little bit deteriorated, but interest rates are low, so they can afford to do that. And the economy is $24 trillion, so they can absorb that shocks. I don't see that impact happening much in the long term. Hmm? Uh, so your views on AI and blockchain technology sector? Yes. Uh, so blockchain technology is here to stay. Blockchain technology is like internet technology, correct? So when internet came in 1992, 93, we in the year 2000, the all internet stocks .com bubble went up like anything, correct? That they says internet is the technology of future. Yes, it happened, correct? But the shares of .com bubble burst because it went way ahead of its time. Now actually internet is doing very good, correct, today. So companies are using it. The same thing is about blockchain, correct? There's a lot of hype on blockchains. So uh, it's going to be a next 20 years. Blockchain technology is going to do well. It's going to be a part of our life every day. uh, so many things we still don't know, we will come to know in next 10-15 years. So companies which are doing a lot of research and using those technologies in their for their customers, we should invest in that. But that doesn't mean we should buy bitcoins. I would avoid that, correct? I would avoid that. So that's like a .com bubble. You can lose your shirt in that. But the technology is here to stay. The technology is here to stay. So we invest in companies which use those technologies very well. So which are those companies which are using those technologies very well? Blockchain. So all, if you see, you take companies like Uber, yeah, you take companies like uh, Zillow in US, or you take companies like in India also Uber is there, correct? You take Siemens, Honeywell, all those companies are going to use the technology very well down the line. Tata Elxsi or IT companies invest in those kind of companies, correct? I wouldn't invest in bitcoins. I have refrained from investing from bitcoins, but I've invested in companies like uh, which are using blockchain technology, uh, artificial intelligence, which are uh, which are all large companies are going to do. Every large company is going to do that. So invest in those kind of companies, blue chip companies, and you will do well. Uh, yeah, I think I don't have any more questions now. Uh, Thank you for your time. With this, I end my today's webinar. Please do share your views, and those who are watching, most of this webinar is watched by people later on. Uh, Please subscribe to our channel and share your feedback with us. Thank you very much. I hope today's presentation was useful in understanding what the market is. Correct? Yeah. Uh, Thank you. Yeah. So before I end up, one more question came up. Recently, we published that telecom sector is going to grow in next 5 to 10 years. Which of those companies get more benefits? Yeah, telecom sector is going to grow in India. Reliance, Airtel, Vodafone, all three companies are going to they are the frontline companies, but there'll be companies which supply cements, or you companies which will supply infrastructure softwares to them. They are also going to benefit. Telecom is going to be a major driver of the world economy. Today, without broadband and without internet, we can't survive. Correct? We can't. I wouldn't be talking to you. So all these technology-driven companies, they will do well, and the frontline companies also will do well in India and in US. Now, Microsoft, Google, Apple also we can call telecom companies because they use telecommunication. Correct? Uh, very well. So all these technology companies should be doing reasonably well. Thank you very much. I appreciate for your questions and have a nice weekend and a happy holidays. Happy Diwali festivals. Yeah. Thank you. Bye bye.